In today's stock market, we saw a sharp decline, particularly in the Nasdaq, as semiconductor and chip stocks led by Nvidia experienced a significant sell-off. The broader sell-off across tech stocks appears to be fueled by concerns over rising interest rates and future demand within the tech sector, with investors becoming more cautious in light of recent global economic developments. Nvidia, a major player in the chip industry, has seen a meteoric rise over the past year due to its dominance in areas such as AI and high-performance computing. However, today's drop in its stock price reflects investor concerns over whether Nvidia's growth can continue at its current pace. In addition to Nvidia, other semiconductor giants like Advanced Micro Devices, AMD, and Intel also saw notable declines, pulling down the broader tech-heavy Nasdaq index. So why the sudden sell-off in chip stocks? It's important to remember that the semiconductor industry is highly cyclical. A lot of what drives these stocks are supply and demand concerns, the state of the global economy, and shifts in technology trends. There has also been increasing caution from analysts and investors alike about potential oversupply in the market, with major economies like China and Europe showing signs of slowing growth. Concerns about demand in the semiconductor space have heightened. Another factor contributing to the sell-off is the ongoing trade tensions between the US and China. Since semiconductors are a critical component of global tech infrastructure, any geopolitical disruptions, especially those that involve tariffs, sanctions, or supply chain interruptions, can heavily impact the sector. Recently, the US government has imposed stricter controls on the export of advanced chip technology to China, which is seen as a potential blow to future earnings for companies like Nvidia and AMD that do significant business with Chinese firms. Beyond geopolitical tensions and cyclical demand issues, rising interest rates also play a role in the stock market's reaction. The Federal Reserve's tightening policy has led to increased borrowing costs, which can make high-growth tech companies less appealing to investors. Higher interest rates typically mean that future cash flows from tech companies are discounted more heavily, thus lowering their present value. In a rising rate environment, we often see a rotation out of growth stocks like Nvidia and AMD and into more stable sectors such as utilities or consumer staples. This brings us to another important point: the broader market trend. While the Nasdaq led today's decline, the overall market is showing signs of increased volatility. Investors are becoming more selective, with concerns about inflation, economic growth, and the potential for further interest rate hikes, making it a challenging environment for high-flying tech stocks. The recent sell-off in tech stocks, particularly in the semiconductor sector led by Nvidia, stems from concerns over rising interest rates, geopolitical tensions, and cautious anticipation of earnings reports from major companies. Despite this downturn, the tech sector's long-term resilience suggests that such dips may present buying opportunities for investors. The strong growth potential in AI and cloud computing remains a positive factor for the industry's future. Please like, share, and subscribe.